$11.63 billion in quarterly revenue for Visa, yet beneath this double-digit top-line growth, a silent margin squeeze is triggering structural alarm bells. Is the market missing a fundamental decline in pricing power, or is management simply paying a calculated premium to defend a massive global payments fortress? Think of this as a real-time puzzle we unpack together, starting with how headline revenue surged 14% year over year to hit exactly $11.63 billion. This optical beat typically satisfies elevated expectations on Wall Street, with observers pointing to families booking international flights or swiping debit cards at local coffee shops. But when you dig into the income statement, you see client incentives grew by 18% to reach $4.68 billion. These client incentives act as direct rebates paid to financial institutions to ensure the company logo stays on the plastic in your wallet. Because these rebate costs effectively outpace gross revenue generation, it implies the firm must increasingly pay up to protect transaction volume from fierce industry challengers. While the crowd cheers the top-line beat, the rising cost of customer retention tells a much deeper story. This hidden divergence brings us directly to the profitability squeeze impacting the business. Investors historically view this payments giant as a pure margin-generating machine, but GAAP operating margin contracted from 60.7% down to 59.1%. At the same time, total operating expenses ballooned by 19%, raising a critical structural question for the firm. We must determine whether the company is losing legendary pricing power or simply entering an era of inherently higher maintenance costs to support a massive digital network. Management is clearly facing a heavier operational burden, which becomes even more evident on the real bottom line. Diving deeper into profitability, the net margin dropped from 51.8% to 48.4%, proving that escalating expenses are actively biting into real earnings. A significant piece of this operational drag stems from persistent legal liabilities, specifically a $237 million litigation provision recorded this quarter. Most analysts casually dismiss these legal charges as one-time events, ignoring that total accrued litigation liabilities now stand at a massive $1.27 billion. For the company, this represents a perpetual, unquantified tax on long-term profitability. While the underlying business model remains incredibly strong, these provisions force management to allocate capital toward defending the moat in courtrooms, rather than expanding it through new product features. Despite these margin pressures, reported GAAP diluted earnings per share jumped 10% year over year to $2.97, projecting an image of pure operational leverage to the average retail investor. The broader financial community is entirely captivated by this double-digit earnings growth, treating it as definitive proof of uninterrupted fundamental momentum. Yet, this per-share growth is heavily fortified by massive financial engineering, specifically a staggering $16.43 billion drained over 9 months to fund stock buybacks. The business is actively reducing its share count, which mechanically boosts the earnings per share denominator. We must weigh whether this aggressive equity repurchase strategy is a sign of ultimate corporate confidence or a necessary mechanism to mask slightly slowing organic earnings momentum. But to fully grasp how the firm affords this financial engineering, we have to examine the underlying cash engine. Despite the optical margin pressures, the company generated an undeniable $15.16 billion in 9-month free cash flow. This metric highlights an incredibly capital-light business model that effortlessly converts accounting profits into physical cash. Unlike heavy infrastructure companies building physical supply chain warehouses, the business maintains a digital toll booth requiring minimal capital expenditures, which came in at just $1.18 billion. This low reinvestment requirement provides a robust financial cushion, allowing the firm to maintain a massive $28.4 billion authorized fund for future share repurchases. It serves as the ultimate anchor for long-term institutional investors, proving that the cash generation engine remains fundamentally unbroken. The international footprint of Visa also tells a highly compelling story. Cross-border volume grew by an impressive 13% on a constant dollar basis, acting as a real-time indicator of global economic health. Everyday observers often worry about consumer fatigue, but this transaction volume perfectly aligns with resilient United States retail sales, which climbed 6.7% annually. Consumers are still traveling and spending across borders, completely shrugging off an environment where federal funds interest rates sit elevated at 3.5 to 3.75%. For the business, this signals that high-margin international transactions are successfully insulating the firm from localized economic slowdowns. Management is clearly benefiting from a global consumer base that continues to prioritize travel experiences over immediate savings despite elevated borrowing costs. However, the company absorbed a hefty $563 million severance charge this quarter, signaling an abrupt end to operational bloat. The public focuses on the immediate hit to net income, but cutting excess headcount is a deliberate efficiency pivot for the firm. The leadership team is urgently reallocating resources to defend its title as the premier global hyperscaler of payments, reinvesting savings into next-generation payment routing technologies and artificial intelligence fraud detection systems. This frames the short-term earnings penalty as a strategic maneuver to accelerate product velocity. The business is positioning itself to capture future technological opportunities before agile competitors can steal its highly lucrative market share. Turning to the balance sheet, a current ratio of 0.99 times flashes a liquidity warning sign at first glance, meaning liquid assets now barely cover short-term obligations. Furthermore, total debt sits at $23.86 billion, pushing the debt-to-equity ratio up to 67.8%. However, this is a calculated byproduct of returning a combined $6.2 billion to shareholders in a single quarter through buybacks and dividends. Management deliberately drew down cash reserves, which fell to $12.36 billion, prioritizing aggressive equity returns over optical balance sheet perfection. Operating with a working capital deficit would terrify the average retail investor, but here it reveals a highly optimized treasury strategy. So, does that slight margin contraction signal a structural decline, or is management just paying the premium to defend a global fortress? The fundamental reality shows us that while the cost to acquire and retain volume is rising, the underlying cash machine remains completely intact. For the intelligent long-term investor, the current valuation reflects a defensive compounding machine rather than a value trap. As long as cross-border travel remains resilient and the business generates immense free cash flow, the slight pressure on operating margins is a highly acceptable financial toll to pay. But I want to hear your take. Do you think this rising customer retention cost is a hidden threat, or just the normal price of doing business at a global scale? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.